Hello, everyone, and welcome to our third quarter housing outlook. Today's focus is on the Mountain and Southwest regions. I'm Ali Wolf, the Chief Economist with Zonda, and I'm pleased to be joined today by John Covert and Evan Forrest, two of our local experts. Before we begin, note that we will be recording the session, and the recording will be posted within 24 hours on our blog at zondahome.com/blog. Please also take note of the QR code on this screen that you can scan to subscribe to receive information about our webinars, reports, and podcasts. At the end of today's program, we'll have an exit survey. Kindly take a moment to fill that out before logging off. As mentioned, we are Zonda. We are the #1 provider of new home construction data solutions. We track the entire building lifecycle from raw land up into the closing out of new home communities. We have our data, our proprietary data, but we also have tools at Zonda to help with analysis, including our staple, Enterprise, the complete data solution for home builders, along with Mortgage Pro and our new Building Products Pro. We also have Livable, North America's largest online new home listing destination. Livable is exclusively for the new home construction industry. It is free to list on the website and leads are free. If you'd like to learn more, please reach out to Karen Bonder at kbonder@zondahome.com. Finally, here at Zonda, I'm part of our advisory team. We have over 60 experts spread across the country doing custom market studies, led by Tim Sullivan, our senior managing principal. We conduct consumer and product research, population and growth studies, land residual analysis, among others. If you need help with any of these, please don't forget, we are here to help. For today's agenda, I'm going to start with the national picture before passing the virtual stage off to our local experts to highlight trends on the ground in Denver, Phoenix, and Salt Lake City. So let's dive in. And I want to start by addressing the elephant in the room, which is if you're joining today's webinar, you've probably heard a bunch of times this week that we are in a housing recession. And I know that this phrase is very triggering. It causes a lot of angst about where we are and where the market might be going. And I think as we look at this, there's been a big debate about whether this is an accurate term to describe what's happening in the market. And I would say technically, yes, we are in a housing recession. And why would I say that? Well, if you go to the Merriam-Webster dictionary and you pull up the word recession, not an economic recession, we're just looking up the word recession is the act or action of receding. When you look up receding, it's to grow less. As we look at today's market, you'll hear it in my presentation, you'll hear it in the following presentations, that the market has most certainly slowed. But I think in practice, what we're trying to make sense of is right now, where the trends have gotten us to is that we're shifting back to more normal levels. Some of the froth and the frenzy and the unhealthiness that we've seen in the housing market over the past couple of years seems to have gone away. So let's look at this. How can we measure where we are? And one of the most obvious ways is, of course, to look at sales. When we look at the housing market, existing home represents 90% of total transactions. New data came out this morning on existing home sales, down 20% compared to where they were last year. Sales from the resale side now back to 2019 levels. And that matches up almost perfectly with the data we at Zonda released this morning as well from our new home pending sales index. That shows total transactions are back to 2019 levels and sales are down just about 20% compared to where we were last year. Now, as we think about this, we know that 2019 was actually a really good, really healthy market for the housing market. But to see how quickly we've slowed, I think is part of the reason that people have talked about the housing recession and how the market can evolve from here. As we look at the market, know that there are some macro factors that impact basically every market. You can't hide from the fact that mortgage rates have gone from 3% to 5% so far this year. And we'll talk a little bit more about that later. But as we look at housing, we know that there are a lot of local dynamics that still become really important. Any of the markets to the left of this dotted line are those that have an average sales rate per month per community that are below where they were in 2019. Any of the markets to the right are on par or stronger than those 2019 levels. So again, going to the markets on the left, Sacramento, Phoenix, Colorado Springs, Fort Collins, Vegas, Riverside, Salt Lake, Austin. These are markets that as we watch them over the past couple of years, they've grown very rapidly for some justifiable reasons: immigration, job growth, the lack of inventory. But as you look at these markets and you layer in the level of home price growth, it makes a lot of sense to me why they would be starting to slow pretty notably. As you look at these numbers, we're looking at home prices that are up between 40 and 70% compared to where we were in 2019. But here's the kicker. When we look at this, I was working with Nick Schoolis in the economics department yesterday with these numbers. If you pull up the home price appreciation numbers to the markets on the right, you see pretty similar trends where you still have 40, 50, 60% growth compared to 2019 in terms of home prices. And my big takeaway here is we can make our blanket statements about the housing market, but price is only part of it. It's a very important, impactful part. But we also want to look at income. We want to look at confidence. We want to look at local supply and demand dynamics and look at investors and see how each of those different components are playing into a market's strength or weakness. But what we know is that sales and starts are very closely linked. And as we look at sales activity that we know has retreated from where we were, typically a slowdown in sales results in a slowdown in starts within a 3 to 6 month gap. And we've already seen for us at Zonda, we called the inflection point in April, and the market has shifted since then. And we've seen that resulting impact of sales slowing showing up in the starts data now as well. So earlier this week, we got the new read on housing starts. And again, the common theme is a 20% reset. So we've seen single family starts are down 20% compared to where we were last year. Where does this put us? Basically exactly where we talked about with sales. When you look at starts, they're back to those 2019 levels. So you can watch this trend. We were at this steady pace in 2019 and early 2020. 2020, we saw these numbers come up. Now we're starting to see them come back down. When we're thinking about a housing recession, I think the most recent memory is this recession on the left that you can see, where we had this big run up and prolonged run up in single family units. And then you saw that massive collapse. We're not calling for a crash. As you can see, we've been more range bound in today's market. We've absolutely seen a correction. But again, that context becomes really important. But as we look at the market, and you'll see in today's presentation a lot of forecasts about housing, we know that builders will respond again to that change in the market. And right now, 87% of builders that we've talked to said they're planning to slow starts. And they're slowing them because of things like cannot start more homes with weak sales, or we're waiting for inventory to sell before allowing more starts. We're cutting starts at least 50% for 2 months. This pause will allow us to assess the market. We're seeing from a builder point of view, a little bit of a pause and assess mentality. From a consumer point of view, we're seeing a bit of a pause and assess mentality. The buyer urgency is not there like we've seen in prior years. But then there's this interesting dynamic where we're talking about inventory here and now. We're talking about starts over the next 6 to 12 months, how we're looking at the market. And then you want to take a step back and look at what we're seeing for land acquisition strategies. We have fewer than 10% of builders that are full steam ahead on land acquisition. We have almost 60% that are saying they're cautiously moving forward, and about 20% of builders that are saying they're pausing on deals entirely. There's a lot of discussions of weighing that pros and cons of do you pause? And if you pause, what if this happens to look like 2020 again? And I know some builders regretted passing on some of their land deals. And then there's a discussion of, well, is this 2020 again? Or is this something that feels a little bit more like a prolonged slowdown in housing? And that can play into that discussion. But again, some of the comments, land prices are higher than I've ever seen. Being diligent and getting the right deals that pencil, even if the market turns downward, is key. Or other builders saying they're being very selective. But there's this third interesting layer of the conversation where starts are anticipated to slow. We still have some moving forward on land acquisition. And then a lot of the time and money that's gone into trying to help address the supply and demand imbalance is starting to show up in today's market. Many of you know at Zonda, we track total upcoming lots. These are lots that are going through different stages of development. And for the second quarter, our data was up almost 30% compared to where it was last year. You can take a look at the distribution. Here, this distribution will almost always look the same, where you have the most or the lion's share of activity in excavation and not as many in streets in. But we have about 6% of lots that are in that streets in phase, meaning they're likely to become vacant developed lots this quarter. 24% in streets paved, and then again, you can see the big cluster in that excavation phase. Now, not all of those lots in excavation do become available to the market within that listed time frame. Sometimes it'll be longer than that, but to us, as we're looking at this, we know that there are a lot more lots that are expected to come to the market over the next 24 months, but the timing, at least in the near term, is a little bit awkward just because we have seen the market shift and the market shift pretty quickly. And I think a big question is, how does this market end up progressing? Because we have, from our data at Zonda, the knowledge that the desire to own homes is extremely strong. We have a lot of different surveys that say consumers are still interested in owning homes, but now we're running into the speed bumps of the record affordability shock and some of the confidence hits that come from general economic angst, and also how much the housing market has shifted and how quickly. So as we talk to builders and ask about the biggest concerns, the number one biggest thing is that there's that hesitancy from buyers. But then the next two would be higher interest rates causing pre-qualified buyers to no longer qualify, or just qualification problems in general. Which brings us to what we're seeing in the mortgage environment. And this is a really dynamic place that we're in right now, because earlier this year, we had interest rates that basically got up to 7%. And as a result of the most recent Federal Reserve rate increase, we saw the Fed raise rates 75 basis points, and mortgage rates have only come back down. So we went from 3% at the beginning of the year, just over 3%, to almost 7%, now back to 5%. Let's look at some of the math. So if someone was able to purchase a $400,000 home at a payment with a 3% interest rate, that equivalent home that they could afford, given the payment change at 5%, was $315,000. And at 6%, it got to $280,000. What it seemed like is when you ask consumers to move from that $400,000 to $280,000, that's really when we saw the market notably shift down. As we've moved from that 7 or 6% interest rate back down to 5%, we're still asking consumers to compromise on a lot. We're asking them to say, well, what kind of square footage are you willing to take? Are you going to take an attached home? Are you going to give up school district? Are you going to move a little bit further than you want? But I think that's an interesting dynamic, that if we start to stabilize out at these levels, you can see how consumers will respond. And what we've seen, and this is not across the board, but we're hearing in some markets that in August, we launched our division president survey this week. It seems like in some markets, there's a little bit of a positive response to at least the fact that mortgage rates are starting to stabilize. So we pulled the question. We said, as mortgage rates have come down a little bit, have you seen any response from consumers? We have some builders, it was a qualitative answer, so I don't have percentages, but there were things like yes, but only slightly. Yes, traffic and interest improved. And I think importantly, yes, calming some nerves. The fact that mortgage rates are not just up, and the fact that we've seen a little bit of improvement on the equity markets, and that we've seen gas prices come down. But then we have other builders that are saying no. Things like consumers actually don't know as much about mortgage rates as we think they do. And so sometimes it's our sales team that's trying to educate and trying to create some of the urgency around rates coming back down. And then some of the comments were, no, there's still hesitation in the market. And I think prices are as much of an objection as mortgage rates are right now. And then again, going back to confidence, not really, still so much negativity in the news cycle. So as we put this all together, it's been tricky, obviously, for all of us to be putting out our forecasts and figuring out exactly what is the point where, if the market softens enough, there's people on the sidelines that want to come back in. How long and protracted do we ultimately see the slowdown and some of the normalization that we're seeing in the market? So I'm going to tell you our thesis for forecasts. It may change as we go in the next couple of months and we take in new information. But right now, our thesis is that the market slows the most notably this year. As we go into next year, we stay fairly range bound where we end up this year, and going into 2024, we have more of a noticeable rebound. For sales, our forecast going into 2022 is that we are down 16%. Again, we're already talking sales that are down 20%, but this is including the first half of the year and the slower second half of the year. When we do our fourth quarter housing outlook, we'll give you our numbers as we go into 2023 as well. For starts, we have them pretty closely aligned with what we had talked about with sales. And so we have start activity down 14% compared to where we were last year. But as we look at the market, I think there are a lot of things that we need to consider. There are a lot of moving parts. And one of those is that whether you're a consultant or a developer or a builder or a supplier, all of us with our respective counterparts were taking orders. The industry was moving so fast and everything was moving, I wouldn't say easily, because obviously we had a lot of headaches with the supply chain and with labor, but it was a taking orders market. And now we've shifted more to that selling. And it feels like in the market, we've returned back to the basics, where as we've talked with some of our clients, they're saying, we're bringing in sales leaders to retrain our staff about what are some of the best practices, and same thing from the marketing side. Again, what we talked about is the demand. We understand that there's still a lot of people that they were unable to purchase a home over the past couple of years because the market was so strong, but now they're bumping up against that price ceiling. What we've seen in response is on both the resale and the new home market, there's been a little bit of a price reset. On the resale side, not every home is selling for the price it's listing. We're seeing some price cuts. From a builder point of view, we have 70% of builders that kept prices flat in July, and we had about 20% of builders that cut prices. Now, obviously, cutting prices in our industry becomes more challenging because of the impact on backlog. But what we've seen is when there is the existence of incentives and when there have been price cuts, oftentimes it does result in an increase in demand. And so to me, this captures the idea that there is some price elasticity in the market, and why I continue to say the phrase that there's this unrelenting demand. But finally, as we look at the market, we know that forecasting comes in different chunks. You have the near term, where housing recession is everywhere and consumers are going to be increasingly anxious about that. And so the near term is choppy and slower, and sales back down 20%. But then you start to look at the medium term. And remember that housing is that interest rate sensitive industry, where as the economy overheats and the Fed raises rates, we are one of the first to slow. But once you get to the point that the economy slows enough and the Fed drops rates, we usually come out on the other side a bit faster too. So I think it's thinking a few steps ahead that becomes really important in today's dynamic times. With that, I would like to turn things over to John Covert, our Principal of Advisory and Mountain West expert. John has 20 plus years of experience studying Colorado's housing market and is a great resource for understanding land and inventory trends. I think my favorite thing about John is that he not only loves making sense of the local housing market, you can call him and geek out over housing, and I think he really enjoys it, but he genuinely also loves where he lives and enjoys the seasons with the outdoor activities of hiking, biking, and skiing. So John, let me pass it off to you.
Great, thanks, Ali. Thanks for the informative presentation, as always. Such great information for us to unpack. And what I'm gonna do is I'm gonna kind of carry what Ali talked about nationally forward into the Denver market and give you a bit of a snapshot of what's occurring here and talk a little bit about where I think this market's headed for the balance of the year and into 2023. So let me start by focusing on what Ali talked about was kind of issue 1A for the builders right now, and that's particularly demand and sales contract activity. So I think a lot of you recognize the variety of information and data sets that Zonda tracks. I'm going to start with sales contracts and traffic. So what you're looking at here, it's a little bit of a busy graph, but pay attention to the blue line at the top. That's our gross sales, the actual number of gross sales per week that the builders are reporting to us on our weekly traffic and contracts report. We've been tracking this using this data set for almost 20 years in this market. And you'll notice that obviously Denver's a little bit unique. Each market is nuanced as it relates to seasonality of buyer demand. Generally, we have a very strong spring selling season here in Denver. It starts to slow down in the summer, maybe a little bit of an uptick once school is back in session, and it kind of winds its way down as we progress through the end of the year. But you can see the dramatic slowdown in gross and net sales in the yellow starting about the beginning of May, just that rate sensitivity that Ali was just talking about. The difference between, of course, the blue line and the yellow line are contract cancellations. And that's the purple line at the bottom of the chart that you see there. And this is getting a lot of press and notoriety right now about the rising cancellation rates that builders are experiencing. And that's the red line that you see. That's our weekly cancellation rate. It's now most recently toward the end of July, reaching numbers around 45% of all contracts written that are canceling. Now, I want to provide a little bit of a disclaimer. When you hear about these high cancellation rates, whether it's in Denver or other markets around the country, it's not necessarily that the cancellations, the net cancellations, the actual number of cancellations is going up dramatically. As you can see by that purple line, they are trending up. But really what's making this cancellation rate go up so dramatically is just the fall of gross sales. And that's what I think Ali indicated very well, or articulated very well, about kind of the downstream impact of this slowdown in sales activity leads to starts, then closings, then inventory and lot absorption, which I'm going to kind of go through quickly here about what we're seeing in the Denver market. So on the left-hand side of your screen, you're going to see starts and closings, our trend going back the last 13 or 14 years. One of the things that I think is particularly interesting about Denver, we peaked in the last cycle for new home starts, all product combined, back in 2006. We started about 20,000 homes. So we still haven't got back. We're roughly 2/3 of the way back to our previous peak of the last cycle. Meanwhile, we've added about 700,000 people to our population in Denver in that same time period. So certainly when it comes to new home building, we've been underbuilding for quite some time. Some of that's been absorbed by a lot of rental apartment construction that's taken place here in the last decade. But notice that green line, that annual closings number, how it sort of leveled off the last 3 or 4 years, roughly averaging about 12,000 closings a year. It just gives you an indication of the capacity that the industry has been at here in this market. In the midst of probably the greatest surge of housing demand that we've experienced in our lifetimes. So it just highlights the difficulty that the home building industry has in completing homes here in this market. We're an expensive housing market. I think everybody recognized that about Denver. But the interesting intersection of starts and closings right now, I think, is highlighted here on the right-hand side of your screen. You'll notice it starts in the second quarter of this year, we're down 2.4%. And I broke this out for you. You could see the level of activity for condos, townhomes, detached homes. So 2% drop in second quarter starts. That actually kind of surprised us a little bit because sales, started trailing off very quickly at the 1st of May, end of April. But really, I think this is because the builders had pretty strong backlog ending last year and into the first several months of this year, and they did a good job of holding on to that backlog. So starts stayed relatively intact. You can see our annual starts pace up just about 3%, annual starts for second quarter of this year. And really what's slowed is our closings pace. So you can see our quarterly closings in the second quarter down 19%, our annual closings down 11%. And this has everything to do with cycle times getting stretched out, which I'll talk about here in a second. We're just having difficulty completing and delivering these homes. So as you may have noticed on that last page, the townhomes and duplexes have really increased dramatically in this market, partly out of necessity, just in terms of delivering more affordable product into the marketplace, just because our detached home prices have accelerated so quickly, but also market acceptance for higher density attached product, I think, has really taken hold in this market. We're seeing a lot of townhome and paired home product being developed out in the suburban master plan community market, where we just didn't see that product out there in years past. But so even though starts have kind of leveled off, at least annually the last year, you could see that townhome and paired home product is up 23%. And we think that this product segment is going to continue to grow, in part because I said the affordability issue really has hit Denver particularly hard the last couple of years. So look at the detached starts numbers by base price year over year, just for the second quarter. I mean, just see the dramatic shift just in the last 12 months for product priced in that sub $500,000 price point. 19% of our starts in the second quarter of 2001 were in that $400,000 to $500,000 price point. Again, this is just for detached homes, and now it's 2%. Annually, an even bigger shift, 34% of our starts a year ago for the previous 12 months were in that $400,000 to $500,000 price point. Now it's 10%. So just this 1 year shift, that's not even counting this shift that we've seen progressing over the last several years. Just this 1 year shift, it's incredible. And the biggest gains are obviously in that $600,000 to $800,000 price point. That's kind of the middle of the market here in Denver. Which leads me to kind of where the biggest risk is now. I mean, of course, builders are paying attention to, like I said, issue 1A is sales demand, sales contracts. Issues 1B is inventory, which Ali talked about. So this is the under construction inventory that you see here in the blue, the number of units that are under construction. So we poured a foundation, but we haven't completed the unit. And then the months of supply of under construction inventory relative to the trailing closings pace over the last 12 months. So what you'll notice, of course, is the number of units is about as high as we saw at the peak of the last cycle. We had more finished vacant spec inventory back in 2005 and 6. Now we have virtually none because it's taken so long to get these homes completed. Just hard time over the last couple of years completing a home and just have a standing spec finished home sitting there. It just didn't occur the last couple of years. So this months of supply of under construction inventory is now roughly 10 months. That's double what it's been over the last 20 years, averaging about 5 months of under construction inventory. And you can loosely connect that to a cycle time. So, it's taking on average start to finish builders in this market to complete a home about 10 months. That's not necessarily a critical issue if demand keeps showing up and we have this intense demand like we've experienced over the last couple of years. You can manage that. Of course, supply chain, labor issues, all the things associated with stretching out our cycle times here in Denver, and probably most markets around the country are feeling this as well. The problem is when your sales demand slows down by half in the matter of a couple of months and contract cancellations go to 20, 30, 40%. So now you've got to sell the same home twice or 3 times at a time when sales traffic, has dropped from 40 people coming into your project per week now to 5. So this is where the builders are really particularly focused on trying to manage this inventory. So if you take that under construction months of supply inventory and segment it by home price, again, like I've done here, there's our 20-year average of about 5 months. Here's where we're at second quarter of this year, about 10 months. Some relatively alarming things start to, show up here. So let's say this $1 million plus product, we're looking at a roughly 18 months of supply of inventory sitting on the market. I mean, that seems pretty alarming. I'm not particularly worried about that because it represents a relatively small percentage of the market. Plus, most buyers aren't going to walk away from their escrow if they cancel that contract at that higher end of the market. And it just takes longer to build these homes. Plus on the lower end of the market, that sub $600,000 price point, look, our under construction inventory is pretty low. We're turning those homes fairly efficiently still. I think we're the biggest risk in the marketplace right now. It's probably what you hear about in the press around the country, and maybe even here in Denver, is that middle of that market, that $600,000 to $800,000 price point. That's where the bulk of our activity is. That's where the bulk of the inventory is sitting right now. And it's taking 10 to 12 months to turn that inventory into a completed home or a closing. And again, with cancellations as high as they are, that's a challenge right now for the builders. And as Ali indicated, we got a lot more lots on the way. We got about 16,000 lots under development currently in Denver. About 3,000 of those are being paved right now. So we'll see those lots delivered into the marketplace if they aren't already here in the next month or so. And then all the stuff that's excavating, we'll see a lot of this turnover and be ready for the spring selling season next year. And a lot of this stuff has been under development for years. Finally, getting ready to deliver these lots into the market. Okay, so you might have kind of put the dots together in your mind, sort of how does this play out? So sales contracts are slowing, starts are inevitably gonna come down the back half of this year. What does that mean for lot inventory? So bear with me here as we kind of walk through how this might play out here in Denver. Sales contracts stay low through 2022, through the end of the year. You know, again, I think like Ali indicated, we've seen the last week or so, traffic and contracts come back up just a little bit, but it's still much lower than it's been the last handful of years, or probably more along the lines of like 2017 or 2018 sales levels. So let's just assume that they're going to flatten out for the balance of the year. New home starts decline the second half of the year as closings, we think, increase because we've got all that inventory out there. Builders are going to be focused on closing that inventory. So we're going to reduce that level of inventory that I showed you a couple of graphs ago. I'm not too concerned about that, but I know the builders are, to try to get rid of that inventory by the end of the year. So we'll see that happen. And then at the same time, we've got all these new lots coming online. So vacant developed lot supply, finished lots are going to increase in this market. We're going to start to see that this third quarter, into the fourth quarter, into the spring selling season, assuming sales activity stays relatively flat. And if that happens, lot supply is going to push back up to a 1.5 to 20 month supply of finished lots. And that's a lot supply that we haven't seen in Denver for 5-6 years. And that's actually what we consider to be a market imbalance when we're at that 1.5 to 2 year supply of finished lots. We've just been such a lot constrained market here. So here's, I think, the difficulty in understanding where we go forward too, is just there's no consensus generally what the builders are going to do. I think there's some builders that are going to continue to push specs into the market. You know, we've been basically a spec building environment for Denver in the last couple of years. And others are going to shift to a more cautious approach of, you know, going back to pre-sold. So they're not going to start a house unless it's sold. And if that's the case, you know, let's say take this more cautionary approach, there's probably going to be a lull in new home starts to begin 2023 because builders are going to just sort of wait to get a little bit more economic clarity about what's in front of them. So again, not a bad thing, of course, it's just a more cautious approach. And if that happens, lot absorption will kind of slow down and it'll give the builders a toehold into some increased operational and sales efficiency. And we'll see cycle times come back down. And they're already starting to improve a little bit as sales and starts kind of slow down, and it gives these crews to catch up on all that inventory that's sitting out there that still needs to be completed. So let me just show you a couple of quick illustrations before I pass it over to Evan. So I do think starts are going to fall in 2022, just like Ali said, nationally. I just kind of built into this model here a 10% decline. You can see from 2021 in the green are our starts going down to 2022. It may be more aggressive than that. And even still, I think that 2023, as we start to look ahead, just until we get a little bit more economic clarity about what's going to happen, let's assume that housing sales slow down. Starts are delayed, as I said, as builders try to remain somewhat cautious before they get a little bit more economic clarity. And let's assume starts stay relatively flat. So then closings for the end of this 2022 year will actually go up over 2021, just because we've got all that inventory still sitting out there. And builders are going to move aggressively to close that inventory. And then let's assume it stays relatively flat. So we're going to see a flattening out, I think, through 2023, and that's why lot supply in this next graph is going to come back up. So vacant developed lots in the green or in the gray here. Housing starts are in the purple. So our months of supply of vacant developed lots, you see, will probably get back up to 20 months of supply. And that, again, that's the highest that it's been since back here in 2014, 2015. We right now, our vacant developed lot supply, second quarter of 2021 is at 13-month supply of lots. Again, an unsustainable figure. And that's part of the reason why we capped out at the number of starts and closings in this market at around 12,000 units. So let me just finish with real quickly. As I mentioned, our highest short-term risk for builders here in Denver is that standing inventory. We'll probably see more aggressive incentives and other vehicles for builders to try to get that inventory moved, whether it's rate locks, just to try to keep those buyers that are out there that are engaged. And as Ali, I think, correctly stated, I would totally agree with her. We have a lot of buyer demand that's still out there. It's just sort of pushed to the sidelines as they kind of grapple with either the appetite to buy a house or the capacity to buy a house. Both have been strained because of the rate sensitivity that's in the marketplace. Price increases are largely done, sort of behind us. It is builders try to figure out how to get that monthly payment back under control, because we know where the price ceiling is now. We just went through it. So now builders are trying to figure out how do we get back to that monthly payment that re-engages that buyer that Ali talked about. So starts are going to slow the second half of the year. Land acquisitions are probably going to be moving more cautiously, as Ali indicated in our builder survey, until there's a little bit more economic clarity. And there are good things about where Denver sits, especially economically. I think a lot of cities are going through this right now. Like, gosh, our economic indicators, the fundamentals are still really strong right now. We're creating jobs, low unemployment, strong demographics pushing behind us. But we know now that these home price increases that we were going through, the industry just couldn't keep up, nor could the consumer. It was just an unsustainable pace, and we're sort of paying for that now. And it's, again, anybody's guess how long this correction lasts, but the priority now is to get rid of this inventory. So I think we're going to see further increases in higher density product in this market, just because we're an expensive housing market, particularly townhomes and paired homes. That's going to be one of the levers that the builders has to push more of that attached product into this market. So with that, I'm going to pass this on to Evan Forrest, my good friend Evan, who I've known for a long time, who does a phenomenal job with what he does. I've tried to get him to come out to Colorado to go skiing and mountain biking and fishing with me, but he's a tennis player, so he's more of a country club sport guy. So anyway, you'll enjoy Evan's commentary about the Phoenix and the Wasatch Front. Take it away, Evan.
I guess I should just say thank you, John. Maybe, I guess. So we're going to talk about first the Phoenix CBSA, and then we're going to run through the Wasatch Front. Wasatch Front basically is Ogden, Clearfield, Salt Lake, and then Provo-Orem. Starting with the Phoenix CBSA, I spoke with one of our market experts in the Phoenix CBSA, Stephen Hensley, who's actually doing our frame right now for Phoenix. And we decided we want to look at average sales rates. A lot of the similar patterns that John described at the start of his thing, we started seeing emerging here. We just saw it, at least with Phoenix. Again, we saw that dip where sales started tailing off in May, a little before that. And then we hit our trough in June, and there was a little bit of, at least according to our weekly sales and traffic, and shown here, again, red is 2022. You can get a little bit of an idea of towards the latter part of July, we started seeing a little bit more, some more aggressive sales techniques as that type of thing that had brought up the average sales rate. But again, we're actually looking at 2017, 2018. So again, like John said a few moments ago, if we start seeing a little bit of the fall selling season, as well as kind of what happens towards the latter part of the year when folks try to close homes and there's not as much selling with the holidays, again, we expect it to be fairly flat through the remainder of the year, even if we have a little bit more of an uptick in August and we kind of stay in that kind of range between the 2017 and 2018 for the Phoenix market. Taking a look at something that is a little interesting and has a little bit of effect on the previous slides, right? So we're looking at this, and this is the number of neighborhoods or subdivisions that are active in each market. We look at right from our Zonda iPad application, looking at it historically. If you look here, we have our active community count is actually up 6% year over year. Again, you can see we hit some pretty bad troughs there in May 2021. Some of that was a response of folks stopping the land machine, right, when the pandemic started, and some was just we weren't bringing on replacement neighborhoods. But we're still down fairly significant historically. 2 years ago, about 10%. But also, if we drew this back out and went back the last 10 years, we're still down pretty far in terms of total subdivisions. So that gross number of subdivisions, or gross number of sales, is still a little bit lower, but we're just getting a little bit more in each one of these subdivisions. So taking a look at that, that leads into what's going on. Again, this is a little bit different than what we saw in Denver, but it follows the same idea that both Ali and John talked about. Here we can actually see the blue is the annual closings and the purple are the annual starts. And you can see we have a fairly significant delta that started to emerge about 18 months ago, and it didn't really start quilling itself until last quarter or so, when we started seeing some annual starts starting to come down a little bit as kind of a response to the metering of sales, as well as the less amount of inventory that was out there and a little bit of the demand, right? So some of our starts in the last quarter, like we talked about, started in May, and some of that demand started falling off. So some of our starts have stopped a little bit. A little surprising was seeing that our annual closings are actually have a slightly downward bent. But again, as John and Ali both talked about, some of that has to do with the lack of carpenters and those folks to do finish work, right? So as we go through and try to finish what is under construction, we'll take a look at that in a second. Some of this closing stuff should start coming a little bit more in line with our annual starts, so that delta that exists right now will not be there. Okay, taking a look, a similar thing, we want to look at the number of units under construction, again, kind of following that same logic there on why we believe closings will at least maintain, if not kind of increase, as we start closing more out. Here you can see the purple bar are under construction and green are finished vacant homes. Now, historically, we start to worry a little bit more when we see the green bar get bigger, take up a bigger portion of the market, right? Not to say that the number of under construction units isn't concerning, because it is, right? We're still seeing a massive amount of units under construction, 19,000. So there still is that large number, that large delta there of, will some of those fall out, or will people close on them when they can? We like to think builders have become incredibly responsible over the past 10 years, that most of those folks will essentially close them out. And if they don't, they'll go back on the market. There might be some incentives to kind of move standing inventory homes with some, but as some of the builders we've spoken to have talked about. Looking at our vacant developed lots in Phoenix, we have seen a steady decline down, right? So for us, again, Phoenix stayed a little more in equilibrium for a little bit longer than some of the other markets, Denver, Vegas, the Wasatch Front, Boise, those markets, right? Where we stayed a little bit closer to the 18 minimum, is kind of our minimum. However, when myself and Stephen Hensley dug into some of those numbers a little bit more, Stephen pointed out that a number of those VDLs are dormant, or they're not active. So this supply and that months of supply is likely much lower, right? We're actually looking at some of the lowest level of vacant developed lots since 2003. So again, some of that has to come back. And as Ali alluded to when she was showing you some of those excavation and the road stuff, that will be coming back. We'll take a look at that in a second. But looking a little bit further into that VDL and seeing kind of along those same lines of dormant and where and why, right? Here, kind of our in-demand lots, the meat of the market is basically $400,000 or $500,000 homes, right? So we're a little bit beneath what John was saying earlier with the 600,000 or so in Denver. Obviously, we don't have as many $1 million homes in Phoenix, but you can see if you're looking at this chart, that gray bar, you can see at the 900 and over, we're at about 40 months of supply. So that's where a lot of VDL is just kind of sitting dormant, not as much being built on them. But when you slide into the 400 or 500 range, you really get a good idea of how many lots are kind of needed, right? Because we're well below the month supply mark, where we're actually below 12. I think 5 to 599 was at about 11.7 months supply. And then the 400 was below 10 at about 8.9 or so, right? So those are where, again, the meat of our market, where we need more lots to be brought on. Taking a look at what's kind of happening, this chart only shows detached lots. We didn't look at attached. We know that attached lots have been increasing in other markets, especially the Wasatch Front in Denver, as John said. However, in Phoenix, we still don't have a tremendous amount of attached lots. However, what is occurring here, you can see on a year-over-year basis, the lots in blue or the neighborhoods in blue that have opened versus the ones that have closed, right? You can see those larger lots that are 65 and above are not being replaced. You're not getting as many replacement neighborhoods, 70 above, 80 above. You can see that blue bar being much, much less in open, but you can see that downward shift to 55 wide lots, 45 wide lots that's starting to become more prevalent. That's been very prevalent in a lot of other markets around the Southwest, whether it's the Inland Empire or, again, Vegas, Salt Lake, Denver, those areas. So you're seeing some of that starting to consolidate. Now, in a couple of years, will we start moving towards having more attached? It is potentially, but there's a lot of land out there, but we're still getting a little denser. Taking a look at what's going on, and this falls in line of kind of what Ali was saying in terms of the lot development activity. We look at equipment on site and excavation in purple, And then roadwork in blue, again, roadwork is going to come online fairly efficiently, and equipment on site excavation takes a little bit longer. But you can see if you look at the far end of the bar, we have a number of lots that are under development here in Phoenix in the Valley of the Sun. So that is a good thing, and that should quill some of that months supply issue we're having in terms of the VDL. So again, think about that meat of the market for $500,000 lots and where some of these are going to come in. Taking a look at our conclusions and kind of our path forward. Again, like we said, building demand started falling entering the summer. Builders in this market have pivoted with incentives for financing and options with some price reductions. We actually went in this morning, did a quick little sample using the Zonda iPad application. We pulled 157 communities, and about 16.5% of them showed a drop in prices in month over month. So essentially from July to August, where we saw 16.5. We probably should have done June to August, but we got about 16.5% in drop in month to month. It wasn't a big drop, however, it was only about 3% in terms of pricing. So again, we're still ahead of where we were at the start of the year, but at the same time, we did see some folks do some drops, but right now more incentives are kind of coming back in the market. Like Ali and John both alluded to, starts could fall 10+% this year, which is logical when you look at the slowdown in terms of starts because we can't deliver the homes, as well as the median of sales. And then of course, the last couple of months where folks got there's some more trepidation in the market. The nice thing about Phoenix, like most other areas, it gives us a hard time in trying to decide what's going on or decipher what's going on is job growth is still occurring. The recent CHIPS Act, I was talking again with Stephen Hensley down in Phoenix about kind of what and how that would benefit Phoenix. And some of those things there's multiple companies that are investing in plants throughout the Valley of the Sun down there in Phoenix. So there are some strong economic fundamentals. We took a look at, finally, it wasn't in here, but it follows that weekly sales and traffic that John alluded to in his first slide. Traffic has increased in recent weeks, and there is a potential over kind of heading into 23, some optimism that we could potentially see some uptick in demand. However, as I alluded to, Phoenix definitely will kind of follow, as well as the Wasatch Front. When we get to it, we'll follow that same idea that we'll likely stay cool and level through the end of the year as kind of some of that oddity kind of works itself out and people gain a better understanding. When Ali comes back in a month and gives you her expert opinion, going through what's happening, I think things will become a little clearer. Moving on to the Wasatch Front, which again is kind of Salt Lake, but it starts with Ogden, Clearfield, CBSA, Salt Lake, CBSA, and Provo-Orem, CBSA. It's called the Wasatch Front. The Wasatch back is basically Park City. We didn't really include that in here, so we're going to stay right in the Wasatch Front, following the same cadence of slides. Similar to Phoenix, this chart shows the same thing, average monthly sales rate, right from our iPad app. And you see the same thing, and almost the same thing has occurred, especially some of the builders we talked to, where some sales started picking up a little bit towards the end of July. Not a lot. Again, no, we're not going crazy. There still was some sales that picked up, and that was a response to a couple builders getting a little more aggressive in their tactics. Again, going back to the basics, as Ali and those folks alluded to, kind of bringing back in sales trainers and those folks and helping people know that you're not just taking a ticket, right? However, unlike Phoenix, we're closing back into 2018, 2019 levels. Again, if you remember, Phoenix was 2017 to 2018. Here we're a little higher, but we expect it probably to kind of level off through the draw of the year and kind of it probably will not follow 2019. It will likely kind of remain steady with maybe slight little drops there, when we get to the latter part of the potential seasonality that most builders are talking about. Again, if you remember, seasonality will generally start falling off towards the latter part of the fall, November-ish. Looking at the same thing's kind of occurring in terms of the active neighborhoods in the market. Here, like Phoenix, a little bit of up year over year, not as much, we're only 2.3%, but we're still down 21% from 2 years ago. So again, there's less potential there. However, there still is demand. So that accounts for some of that backup and some of that kind of delayed demand where people are more comfortable sitting on the sidelines. A little different, taking a look at the Delta and what's occurring in the Delta. This is what we'd expect to more occur as opposed to Phoenix. If you remember, that blue bar was actually heading down. In this one, you can actually see that the purple annual starts and the blue bar annual closings are actually starting to kind of shift towards each other, which is what you would expect as a number of those homes that are under construction, as shown on this page, are starting to close, right? So if you remember, there was about 17 or 18,000, give or take, annual starts, but we only have about 13,000 units under construction. So we are starting to close them, and that's kind of where you saw that delta start shrinking on the previous page. But here, again, we start worrying when we start seeing more finished vacant homes come online. So But the builders, again, have been responsible when they have some of those cancellations come out, where they start offering some sort of incentive, getting a little more aggressive, and that's kind of what's happening there. Taking a look at vacant developed lots, similar to Phoenix, we're well below equilibrium. We're actually, overall, we're well below 10 months. We're at about 9 months or so, give or take. But again, we haven't really been in equilibrium in the Wasatch Front since 2016. So it's been a while. But again, you can see the vacant developed lots have been fairly stable since 2017. There isn't a huge jump up and jump down. So that really accounts for the demand and the folks that are moving into the market that's strong in migration from Silicon Slopes, the lifestyle, and the strong schools that the Wasatch Front has. Looking again, similar to what we saw in Phoenix. Again, a little bit of a broken record, I apologize, but you have similar things happening. Again, that $400,000 or $500,000 range, right in the meat of the market, right? And that's about 41% of the market. And both of them have under 8 months of supply. You can see there, the 400 is closer to 5% of the market, or I'm sorry, 5 months of supply. So again, they're both falling down slightly. But again, when you go to the more expensive stuff, that's when your month supply goes much higher. And that's when you start talking about some of those dormant lots that are just kind of sitting there waiting for something, just because they have a much slower sales rate. Little different here. This market, as opposed to Phoenix, we are seeing many more attached products coming online. I didn't take it out of this one, but this is much more pronounced in terms of what's sold out and open, right? Here you can see here, yes, 80 plus wide lots, big delta. But when you start getting down there into the 40s, right, we're getting a lot more, we haven't been opening as many of these smaller, more dense lots. And some of that's a response to builders recalibrating and replanning from what we've talked to, as well as some of those lots just not being ready. And then finally, took a little bit of a different look. So you can see the 3 different CBSAs. I apologize, probably should have Salt Lake in the middle, but I went alphabetically, sort of. Here is, you can see development activity continues, but I wanted you folks to see where it really was. And the meat of the market is really in Provo-Orem, where about 52% of the market is where the lots are going to come. And that makes sense. It's a little harder to get up to Ogden Clearfield. There's definitely opportunity up there. And then when you get in Salt Lake CBSA, you might be starting to go out to Tuella and a few other areas. And there's, Daybreak, which is one of the best master plans in the country. But for the most part, people are heading south, whether it's to Eagle Mountain or down to Payson, Salem, in those areas where there's land and people can start buying land. There's a little bit of hesitation from some of the buyers, but most of the folks we've talked to are still out there looking for land, depending on when they're looking to close it. And sorry, looking at our path forward, very similar. Builders have used different strategies, a little bit different here than in Phoenix, a lot more in the Wasatch Front. We actually have seen a differentiation between folks that have just dropped prices versus trying to use incentives and a few other things on the same inventory. In the same vein, we did a quick little survey of about 70 neighborhoods, and 14 of those basically saw price drops month over month. So again, July to August. So a little bit, some folks are doing some price drops. It's, again, not a huge number in the overall price they're dropping, 2-3%, about 2% or so, I think was the number that came out. So again, we're not seeing the huge price drops, but enough to kind of incentivize people, at least help people kind of get a little more excited, going, maybe I'm getting a little better deal. Our in-demand lots, again, that 400 or 500 range lot, we're undersupplies and we need replacement lots there. And hopefully some of that will be coming. The difference of kind of Salt Lake and the Wasatch Front is there's very strong in-migration. And it's a lifestyle, economic fundamentals. And again, that Silicon Slopes, that intellectual capital that is being drawn to the area just because you have the massive outdoor ability there. And then finally, some of our conversation with builders, we are seeing a little bit more quality traffic with some more aggressive sales techniques over the past couple of weeks. I apologize. But again, it has been a little more quality traffic, but they are having to, quote unquote, as one person said, work now for their sales. And then finally, similar thing, our weekly sales and traffic is showing a little bit of the same thing, especially after hitting the troughing out in the middle of July. But again, overall, similar to Phoenix, similar to Denver, and similar to what Ali's saying nationally, we believe, at least again in the Wasatch Front, despite all the things going for it, at least for the draw of the year, we expect to make a little cooler through the end of the year. And with that, I'd like to thank you all for coming. And a couple of quick reminders. Again, this webinar will be sent out to you, I think tomorrow is what Manfredo said. And then also, if you haven't heard, please sign up for our multifamily webinar next week with the indelible Kimberly Byram, who's just an amazing expert in the field of multifamily rental. And then finally, if you could, after this, if you could fill out the questionnaire that we have coming, we would really appreciate it so we can gauge a little bit more of what folks are looking at and how everybody is feeling. And with that, I will say thank you and I also thank for Ali and John and Amanda Prieto, as well as Val Sheets, who did such a wonderful job putting this together. Thank you very much.